I'm James Patrick, the director of BigPicture.Watch. In this interview I conducted with David Webb, we discussed the issue of markets being manipulated. How are they manipulated? Is the gold price manipulated? How is this done? How much of the markets do you think are manipulated as far as, let's say gold, for example? Do you think the gold price we have is a real gold price, or how?
No. No.
So how does that work?
Well, I think lots of people know by the way gold has traded for a long time that it will reach certain points where an enormous volume of gold will be sold on a paper basis. So it's not the real physical metal. And this is a case of wag the dog where they've created paper instruments that just dwarf the physical reality of anything. So that way they can put a blanket on things and control the real world through the artificial world of these of financialization. So there's a feedback mechanism from the artificial paper into the pricing of the real stuff. They can control the artificial. So what people have seen is all of a sudden, $1 billion worth of gold will be sold in a very short period of time, which it's done in such a way that it clearly shows that a rational investor is not behind that. It's not something that a real seller would do in order to maximize their prices on the sale. It is done in a way to collapse the price and in scale, in volume. So who is doing that?
You're saying in the gold markets, you can see from the trades that there's some organized attack on a price?
Well, organized and I would say concentrated. It doesn't even have to be, it's organized in the sense that there's an intent behind it. But you're left with the question of what sort of entity could do this or would do this, sell in a manner which assures realizing lower prices on the sale, not maximizing prices on the sale. So it's contrary to what a rational, seller, as an individual or an institution would do. So what?
And you've observed this in the gold. You've observed this yourself in the gold markets.
Well, I've observed it. I have not actively trading myself in that, but observing the price movements and seeing what was reported in terms of the size of the sale that made that happen. So it is through news reports. I'm no longer looking at screens where I'm seeing the actual sales at this point. But this has been going on for a long time, so it begs the question: what sort of an entity would do this? And it seems to me that it must be an entity that does not have to care about the economic gain or loss associated with these actions. So one way to do this, or one purpose behind it, which now I can't prove this, but I think it makes sense. The way I explain it is there are entities that have, when you look at a holding company, you have subsidiaries where you've separated assets, you've separated good assets from liabilities in other entities. So these entities could have a subsidiary that is selling gold, essentially knowing that there will be losses associated with this sale. And another entity within this holding company is buying physical gold at that time. So it's one hand that perhaps will be allowed to fail at some point, where the losses are taken, and the other hand that is designed to hold the solid assets that is buying. So they can manipulate the market with different entities that are selling paper and buying physical, for example. So the entity that is selling using the derivatives market, those positions can ultimately be the exposure will be borne through the mutualization of the losses.
Okay, so you just then the books of the firm would be awash if they bought and sold at the same time?
It wouldn't be a wash, because there would be one entity that is exposed to bad economic actions and another entity that is being positioned to hold good assets. It could be done.
Okay, so the books would match out?
No, I think they keep separate. They keep much different books. And so what I'm saying is you could have entities that are off balance sheet. The Fed can create entities and loan money into them that are completely opaque. It is possible that there are different sets of accounts that are not apparent. So I wouldn't say it's a wash. It's a strategy to put the losses essentially on the public, while consolidating power with hard assets. It could be done.
Okay. So do you think the central banks are making money out of nothing and manipulating the markets of certain commodities, like gold?
Well, I mean, the Fed and the banks, of course, are creating money out of nothing and manipulating the markets. Absolutely. All markets, the entire global financial system. So that's not wild conspiracy theory. They're definitely. It's being done in scale with the entire financial system, the scale of the bubble and the financialization. But one could also look at behavior of individual parts of the market or gold and say, this is odd behavior in this. The way you see the odd things is when there are actions that are not what a rational investor would do. Or when, so I think there are signs of gold being driven down at certain points.
What is the point of driving gold down for these guys?
Well, because it can be contained, so the physical gold can be bought. That's what I'm saying. So why would you hold down the market? Because you're accumulating the physical. So you sell in the paper market, the losses will be borne by the public ultimately, while the physical gold can be accumulated.
How does that work exactly? You explained it already, right?
Yeah.
Yeah. Okay.
In what
you're
way?
Selling and buying? You're buying the physical at a lower price. You're selling it.
Okay. Look. The way to understand it is, if you are a person, an individual, it wouldn't work for you because you're the same person. Yeah, so you can't manipulate it for yourself by selling it so you can buy it. It doesn't work for a person or for a single entity. It only works if you control different entities. So you cause one to do the thing that is injurious, but the losses will be borne by someone else. Okay. While you do the thing that so you can control the outcome, you can control the timing, you have complete control over the execution. So think of it the other way around. We want to accumulate a big slug of gold here in this entity that is we have set up to hold good assets. That's our objective. We're accumulating the physical gold. We're going to use this entity that we control that is using the public's assets as collateral to sell gold in volume at the point where we intend to buy it physical. Easily done. Mm-hmm. They're completely different entities, so it's not. It could be done within, two different parts of a financial conglomerate, or it could be done within the banking cartel with entities that are slated to be pancaked to fail, while other entities are taking the other side of that trade. This is the way markets work. If you know that there is a big, stupid seller of something, you position on the other side of that. And you draw them down. You help them to collapse the price level so you can buy it. So when I was running these hedge funds, we had these hundreds of positions on at the same time, both things that we owned long and many more actually small short positions. And what we were doing every moment of the day really was monitoring the price movement of these individual positions and focusing on things that were moving oddly out of context with the market.
So you ran a trading operation?
Yeah, I've done that very, very intensively. So part of what we would do is pay attention to things that were moving out of context with the market. So there are things that are moving up more than the market or down more than the market. Then you would also have to look at the sectors. So maybe a group, maybe semiconductor stocks were being sold or bought. So there was a sectoral explanation of, so it was a matter of the money flow going into or out of an individual position or a sector of the market. And then you would look for opportunities to get on the opposite side of that flow. Or you needed to understand what was really happening there. This was the research aspect, to dig in to try to understand, was there some news relating to that specific thing as to why it was moving, and you'd focus immediately. But if you understood the situation, we also worked at having probably a better understanding of the situations. You work to be on the opposite side of the buying or the selling. So if there's urgent buying in something, you're considering opportunities to sell into that, and vice versa. So put simply, in order to buy something, there has to be a seller. You can't buy it unless there's a seller. And if you have to buy a lot of it, a significant amount of it, and we were managing a lot, it had to make a difference. You need a larger seller there that is motivated. So how do you see that? We had what was called a level 2 system, where you could see the market makers in terms of what size they were willing to sell or buy, and at what price level. So, and then the space in between that is the spread, is the price spread. So a firm that has orders to sell might, so this is on the offer side, they have orders to sell, but they might actually present as a buyer because they want to hold up the market to keep the market from falling. So they might actually show a bid for 100 shares, at it might even be the best bid, when they're in reality a seller, and vice versa. So you come to detect these things when we would start engaging in a situation. We would start to probe these bids or offers to see what was really there. So, for example,
What are methods of probing?
Well, so let's say there's a best bid that's 100 shares. If you suspect that there are sellers, and you are actually a buyer. So it's a little complicated. So let's say you would be willing to buy this, but at a lower price. And there are sellers, or you want to see if there are sellers, but someone is propping up the market with a bid for 100 shares as the best bid. You might be a buyer, but you might take out that bid, sell the 100 shares, and in order to cause them to take their bids away. And then the market starts moving down. Another way to do it is that there is a best bid, but you show more size just below that best bid. This is really what we would do, because we wanted to buy it. So we would so there's a bid for 100 shares. Maybe we would show 2,000 shares to buy, just a little bit below that. And what you would see, if there were motivated sellers, they would hit the 100 and our 2,000. They would reach through in order to get a little bit of size done. So they take out the 2,000, and now the bids would move down. The whole market would react and the bids would move down. And then we might put another 2,000 shares just below that level, and they might reach through that. You could then see how aggressive they were to move it. And the participants knew this. They knew that it would have to get to a point where they could start getting size done. The sellers could finally get stuff sold. It was going to be at a lower level. Now, if you could get a situation where there were multiple sellers, you could get them competing, and that would help to move it down, much more and faster. And if you were in something that was a broader price decline, you would find this happening over many positions at the same time, that they would just look for ways to reduce their market exposure by selling. So they would look for wherever they could get liquidity to sell. And we just made sure that we were buying what we were willing to buy on that kind of a move. So it might have been something that we wanted to own as a long position. So we would increase our market exposure when others were trying to reduce their market exposure at certain points, at turning points. So it might be adding to long positions. If you're in an illiquid short position, you have to have sellers at some point in order to be able to reduce your short position. So in these panicky moves down, we were always positioned to reduce our short exposure into the panic, not panic into the panic, to buy into the panic. But you have to wait. You have to work things down to a point where it's time to start reducing the exposure. So So in order to buy, whether it's to cover a short position or to add to a long position, there has to be a seller. So what we worked at was an intelligence system in the market to basically figure out where there was selling pressure coming in something, and we could be on the other side of that. Now, what's even better than that? It's when you can control the selling or the buying. You can control both sides of this. You can know exactly the timing. You can orchestrate the whole thing. But the key is that it's not done in a single entity. It's not a single if a person is selling in order to drive the price down so they can buy, it doesn't work that well. If it's in one entity, but if the kind of behavior that is not what a rational investor would do to maximize their price, if that's done in an entity that is basically set up to house losses over time.
But then at some point, do you lose money when you fold the entity, or you just let the losses go away?
Well, the losses can be masked for a long period of time. And I think that so this can be done in small cycles where there's a washout at points. That's clearly what the global financial crisis was when that happened, was a purging of the losses in entities that perhaps had been the stupid buyer or the super stupid seller, when other entities are preserved to hold the good assets. So the entities that would be used as the loss-taking entities are the ones that will be the public will be ultimately be exposed to. I'm just saying, we went through the example of gold and how that could be done.
But how's the public exposed to it, and what technically how?
Well, in the I think there are two ways. One is through entities could be set up that you never see, that are off-balance sheet entities. So we know that the Fed has the power to create entities and loan money into them, and those don't need to be reported anywhere. And the money that was used in those entities comes out of thin air. No one has to know about it, and it can all just be wound up. So it can be used to move the markets in different ways. Now you'd say, well, they're going to lose money on that. Well, the money was created out of nothing. Who loses the money? The public loses purchasing power every time that is done. So the simple example that someone gave to me is, you have $1 and the Fed creates $2. Now you have a third of the purchasing power you had before, and they have twice the purchasing power you had before. So this can be done in the scheme of things with creating entities that essentially use our money, to create these entities. They can eventually just disappear. It can all be dark, but it basically takes, it's as Ed Griffin would say, it's a hidden tax. So there are many ways to manipulate the markets by an unseen hand.
So how can a private firm or just make a off-balance sheet entity and have all these things that aren't on their books? I mean, is that just spinning up an entity and parking things in it, or what? How could, if it's off the balance sheet, it's just a separate entity, no?
Well, the key is that, a central bank can do this because of the murky powers of the central bank. It's something the key is that it's something that is private, doesn't have to be reported, registered, reported, can be done quietly. I think this is just one possible explanation of the strange movements when you see things moving in a way that is not what a rational person or entity would do. So to suddenly sell large amounts of something in a very short period of time, it's clearly meant to drive the price down. Why? Well, presumably because someone is going to take advantage of that. So it wouldn't be done in the same entity. The entity that would drive it down would be one entity. The losses on that will either just be mutualized through the money creation, or the losses will be in an entity that will ultimately be exposed to loss by the public. This is the banking cycle. This is, I think, a recurring thing. So I guess my point here is it can be done both in entities where there is reporting, but the losses are not apparent yet, and at some point they become apparent. Or that can be supplemented and complemented with losses that you have no visibility on at all, that will just be buried. It'll just disappear.
So you'd have a company controlling different entities. You're saying they're still a part of a mother company?
Well, it could be done. It could be done within, let's say, a holding company, where the entities that are holding, let's say, for example, the derivatives books were moved into the deposit-taking entities of the banks. So they're backed by the bank deposits. Now, there is that is something that did not benefit the depositors. There is no reason to do that, but the Fed gave broad exemptions under Section 23A, is what it's called, to allow many banks, this is in the aftermath of the last financial crisis, to move their derivatives books into these deposit-taking entities. Now, this, I think, was done to demonstrate that they can do it. There were a lot of things that were done during the great financial crisis to demonstrate that they can do it, and they've done that. And what that means is that money on deposit, even in the subsidiaries of the too big to fail banks, can be lost, because those subsidiaries that can be allowed to fail, and the rest of the bank or other parts of the bank are designed to survive. So this is an example. Now, the derivatives books could be used to manipulate the market, absolutely. And then the losses on those derivatives will be borne by the depositors that will be wiped out. That's one example of how it can be done on the books, and you see it.
Yeah. And then, so how big is the derivatives market?
Well, in
Briefly. Yeah.
in the early 2000s, it was about 2 times GDP, about 110, 120 trillion. And I was worried then. And then by 2007, it was 700 trillion. So it had that made it about 10 times global GDP at that time. And there are different estimates of the size now, but some people are saying it's 2 quadrillion, which would make it about 20 times global GDP.
But that's, so in 2007 it was 700 billion.
700 trillion.
Trillion. And then now
It's
they're
more
saying
than
it's
double.
only
Yeah, it's
double.
more than double. Yeah.
Since 2007. That seems like it could be more, no?
It could be. It could be.
Yeah.
But I've heard that figure of 2.
2 quadrillion, yeah.
Yeah.
So is that a liability?
A liability. In what sense?
For the markets collapsing, or
Could there be a problem with the derivatives market?
are we on the verge of economic crisis?
Are we on the verge of an economic crisis? The biggest issue, the elephant in the room, the big elephant in the room, and that's an understatement. It's like a whole herd of elephants in the room, is the reversal in interest rates. After interest rates being at 0 for 15 years, pretty much, to go back over 5%. So, I've given this example before that if you have a perpetuity, and essentially the economy is a big perpetuity. So if you have a bond that's a perpetuity that's paying $5, interest rates are 5%, the bond is worth $100 because 5 is 5% of $100. Now the bond continues paying $5, but interest rates are driven down to 1%. Now 5 is 1% of $500. So you get a 500% increase, or a 5-fold increase. So that is what was done after the great financial crisis by dropping interest rates to 1% and even lower. Now, when that reverses in this example, if interest rates go back from 1% to 5%, the perpetuity goes back to $100. So you have an 80% loss. Now, that kind of magnitude of loss is already embedded in bonds, in real estate of all kinds, globally, and the equity market, although you don't see it in the way it's priced, the equity market theoretically discounts back future cash flow of these companies. So there is a very strange disconnect between the equity markets and what interest rates have done. But even aside from,
it should be lower.
Oh, much lower. Yeah. So even aside from, there would be a massive market crash just given the move in interest rates, which is not happening.
It didn't occur.
Well, it hasn't occurred yet, but
Yeah.
but the losses in all kinds of real estate that are based on cash flow streams, the losses in real estate globally are many, many trillions of dollars in losses. And of course, banking entities are exposed to this, but you're not hearing anything about it. It's being dribbled out with, oh, well, here's a loss of $100 million, or even something like, these little bank failures have been figures in using the B word, so billion, not, but this scale of the losses. So when you say, is there going to be a problem? It's already here. The scale of these losses is being masked somehow, but they're there, absolutely. So the cake is baked. Then the derivatives market and the stock market, one way that things might be propped up is through the derivatives market. This is where something unreal is used to control something real. And so institutions broadly have this illusion that they can cover their downside exposure in the market through the derivatives market. Well, that works if you're going to have a counterparty that will honor that. But if the counterparties are going to fail in the collapse, then all of the apparent stability in the market at this high level is an illusion. It's hedged with contracts that cannot be honored. So that's a problem. And then we have the scale of the derivatives market where there really is not enough of anything in the world to back it as collateral. So the financialization has been taken to such a level that it is there will be a washout at some point, and that is when the real assets will be taken. So this is what we were talking about, how you can use entities to do things that do not make economic sense, while other entities are controlled that are doing things that do make economic sense. That's how it works. For 400 years, securities were property. We had property rights, and this was true everywhere. And what this meant is that if the securities firm failed, you just take your property back. And if they didn't give you your property, that was criminal. Now, that is absolutely not criminal for them to not give you your property back. It's as simple as that. So that was done by turning it into a contractual claim. And with this newly created concept of a security entitlement. The securities are now all pooled, so you only have a right to a pro rata share of what is left in the pool. Even major institutions, pension funds, institutional investors are subject to the same thing, because if they're told their accounts are segregated, that is only in the books and records of the custodian. It's not true in terms of the pool. And we know that from the Fed response to the legal certainty group. So the thing is, what allowed the derivatives bubble to grow as it has? It is that in the 1990s, they were working on doing this, implementing this, severing the property rights of the securities owners. And they had already begun, they were already using the client assets in this way. It was their established practice. They just had to make it legal now. This is the way it was explained by the people that implemented this, was that they were just modernizing the system to catch up with the fraud that was already taking place and to make it legal. So what this did was to unlock a tremendous amount of collateral for use by other entities. So they are able to use the client collateral in these pools without restriction, with no review, without restriction, and free of payment, FOP. So I think it's quite clear that, because it was coincident with the growth of derivatives, this change. So it was the bubble we're in, the derivatives bubble we're in, was made possible by this subversion of taking essentially all the securities of the public in the world and pyramiding it up. Now, why would you do that? Because they're taking it for free, they're exposing it to loss, but when the losses come, they will actually take all those shares because they've engineered it that way. So they both benefit from the pyramiding of it, but then they have also assured that when it's pulled, they will not bear any of the losses. The public will bear all of the losses.
So it's a sort of pump and dump? Like
Yes, over and over. That's what it is.
some kind of the too big to fail banks have a privileged ability to use all client assets.
They have a privileged ability to use all client collateral, and then a privileged, they are the protected class. They are protected to then take the client assets. You see how neat it is.
So when do you think they're going to take the assets? In some sort of economic conflagration under a crisis, or what?
It will happen very suddenly. Not that there won't be a lead up to it, which we're already in. I mean, we're seeing it. We're in, and there are many end stage phenomena that we're in. And what I mean by that is when, in this cycle, there's a period where the created money being created out of nothing by the central bank and the banks, is actually going into productive uses. Mm-hmm. It is actually being used in the real economy. But then in the latter stage, which was beginning after the Asian financial crisis in the 90s, this transmission into the real economy begins breaking down. And then the created money is increasingly going into financialization and warfare. And we can see this, so that was beginning with the global war on terror and the dot-com bubble, and all that has happened since, and it is continuing. It's not going to go back to normal. Clearly, the biggest thing is the growth in derivatives. Uh-huh. And, people, you're asking the right question. People should be wondering what enabled that. And it's the use of the customer collateral, free of use, or free of payment. So absolutely the linchpin of this whole thing.
Yeah. And then, so how is the size of the financial world compared to the real world?
Well, I mean, just saying that the derivatives bubble is 20 times the size of global GDP. They're really, you can scale. I mean, I don't have the figures right in my head right now, but you can scale all the gold in the world, all of the government debt in the world. These figures for government debt sound quite large, but they're dwarfed by the size of the derivatives complex. So what that tells you is when the day of reckoning comes, someone is going to be left with nothing, and someone else is going to take what's left, which is the real stuff. Mm-hmm. And so it's really a geopolitical strategy it's an architecture. It's very simple to sever the property rights, use the property to pyramid this up, create the conditions for a collapse, and then to take the property in that collapse. I think it's very clear there's a strategy. I mean, if you keep interest rates near zero for 15 years, what does that do? Well, it encourages indebtedness. As I say, those the gods would destroy, they first encourage to borrow cheaply. And that's what was done. So not only individuals and households, but all public companies have high debt levels in the name of capital efficiency, borrowing cheaply, and maybe they locked in at low rates. But if you have a profound decline in price level, as I would say was engineered in the Great Depression, then any amount of debt is very difficult to service, even if the interest rates were low on that debt, because the debt, the face amount of the debt does not deflate. that does not decline. But everything else you're doing to create an income stream is dramatically reduced. And then if that condition is maintained for a number of years, anything encumbered with debt will be taken. Also, that's the old-fashioned way of doing it.
How big is the financial world compared to the real world?
Oh, I think I just point to the size of the derivatives.
So if you're talking at least 2 quadrillion and the whole world economy is 100?
It's 100 trillion to 2 quadrillion for the derivatives. You just have the orders of magnitude down, the proportionality that it's something like that. It's in nice round numbers. It's that kind of proportionality. So anything else in terms of the scale of the capitalization of equity markets, those are small numbers compared to the size of the derivatives complex.